It happens time and time again. Retail investors pile into the latest hot IPO only to see the share price fall 3 to 6 months later. Why does this seem to happen so often? There's a pretty simple answer. The insider lockup period has ended, or it's about to end soon. Pretty much every initial public offering that's underwritten by an investment bank has a lockup period specified in the company's S-1 filed with the SEC. In case you aren't familiar, the lockup period is a window of time, usually between 90 and 180 days, when insiders like employees and pre-IPO investors are not allowed to sell their shares. The lockup is also sometimes referred to as a market standoff, and without one, there would be tons of selling pressure on day one, flooding the market with shares and most likely causing the share price to go down from the offering price. Besides preventing a massive initial sell-off, the purpose of the lockup is to maintain the public's confidence in the company. But let's be real here. Investment banks that underwrite these IPOs require lockup periods to protect their own reputations and make sure that their institutional investor clients make lots of money. Not surprisingly, it's common for pre-IPO investors and company executives to have a slightly shorter lockup period relative to regular employees so that they can dump shares before the price declines. So what does this all mean for the average retail investor like you and I? Well, generally, the worst time to buy an IPO stock is right at the market open on day one when hype and FOMO are at the absolute peak. There's so much buying pressure immediately following an IPO because existing shareholders just aren't allowed to sell. It's basically like Robinhood taking away the sell button. Of course, there are traders who flip shares successfully on IPO day, but largely, demand outpaces supply on day one. Conversely, the best time to buy is typically when the supply of shares overwhelms demand, causing the share price to fall. And not surprisingly, that's when the lockup period ends. In an instant, the total float or number of shares publicly traded can double or even triple in some cases when insiders are finally allowed to sell their shares. Unless this new supply of shares is met with an accompanying increase in demand, the stock price is likely to fall, at least in the short term. Think about it. Insiders have been waiting 5 to 20 years in some cases to cash out and realize the fruits of their labor. So it doesn't necessarily reflect poorly on the company when there's heavy selling pressure after a lockup expires. Also, the average employee at a newly IPO company likely isn't a savvy investor. So they can be prone to panic selling when they see the share price dropping on expiration day. All this panic selling creates a great opportunity for patient and rational investors out there to buy the freaking dip. The stock price can recover pretty darn quickly after employees and early investors have had a chance to get some liquidity. Now, every employee won't be selling their entire stake on day one because some may have purchased portions of their stock options less than a year ago and they may be holding out for long-term capital gains. So far in this video, I've been focusing on the lockup expiration day itself. But in reality, an IPO stock price will typically react to the anticipation of a lockup period ending ahead of time. In other words, the share price will often decline a few days or weeks prior to the expiration date as investors look to exit the stock before the new supply of shares hits the market. There's many examples of this happening, and one of the more noteworthy instances is with Uber. Back in late 2019, in anticipation of 1.7 billion shares being made available for trading, Uber's stock price gave up 17% in the days leading up to the lockup expiration. Also take a look at Airbnb stock, which IPO'd on December 10th, 2020. Not only did the stock price decline in the weeks leading up to the lockup expiration on May 17th, 2021, the share price lost another 6% on the actual expiration day. For potential investors who have been waiting, sitting on the sidelines to buy Airbnb stock, May 17th provided a juicy entry point. Another thing to keep in mind is that sometimes there are multiple lockup periods for a single IPO. This is done so that the market isn't flooded with a huge new supply of stock all at once. Usually, multiple lockup periods are used for larger IPOs with a substantial amount of shares owned by insiders. Make sure you're aware of all of the lockup periods associated with any particular IPO so that you don't get surprised when another large tranche of shares expands the float and drops the share price. If you're having trouble identifying the lockup expiration dates, then consider checking the S1 filing. But also make sure you keep an eye out for updates, as underwriters can change the dates. An example of a company having multiple lockup periods is DoorDash. DoorDash IPO'd on December 9th, 2020, with about a third of total shares available for trading. Their initial lockup period ended March 9th, 2021, doubling the float available for trading with another third of the total shares coming online. And the final lockup ended May 18th, 2021, where the remaining third of shares came on the market. You can see that the stock declined a few weeks in advance of each lockup expiration, providing new investors with entry points. But it's the most patient investors who waited for the final lockup period to expire that were rewarded with the lowest available entry point to date. So how can we, as retail investors, capitalize on the knowledge of when the lockup period is ending? First of all, you need to know in advance when a lockup is set to expire, so go ahead and do some Googling. If you can't find the lockup expiration easily, then you can search through the company's S1. The most straightforward way to capitalize on the end of the lockup is to buy the dip on the expiration day. Sure, it might not turn out to be the 100% optimal moment to buy, but it is way safer than buying an IPO stock right after it hits the public market. Another possible way to mitigate the risk of buying too high around the lockup is to buy shares in partial increments, rather than going in all at once. For example, you could buy some shares on the day before the lockup ends, and then buy even more on expiration day if the share price drops further. So buying the dip isn't the only strategy that you can use to profit off information regarding lockups. Remember, there's usually a lot of anticipation around the end of a lockup period, so the decline in share price often starts 2 to 4 weeks before the expiration date. And sometimes that anticipation among investors drives the share price lower than the actual expiration day. Just look at Lemonade, the online insurance company, whose shares dropped 15% the day before the expiration. A way to capitalize on this decline leading up to the lockup expiration is to buy put options 4 to 6 weeks in advance of the lockup period ending. Just make sure that the expiration date on the put option contract is after the end of the lockup period. Buying puts can be a nice hedge if you're overall bullish about a newly IPO company's future, but want to be cautious about a potential short-term drop from the lockup. Watch out for high premiums on those put options because there will be other savvy investors with the same idea. If you have a strong conviction about a share price decline leading up to a certain lockup expiration, then consider buying those put options sooner rather than later. Of course, the decline in share price leading up to the end of a lockup doesn't always play out as I've been describing. If an IPO stock never ends up coming down around the end of the lockup period, then so be it. Worst case is that you missed out on one successful investment opportunity. It's better to substantially limit your risk by avoiding buying an IPO stock right after its debut and instead wait for the stock price to stabilize around the end of the final lockup period. There are plenty of other IPO trading strategies not mentioned here, and if you're just in it for the day trading or swing trading, then you can play the volatility around the company's debut, albeit with a lot more risk. So with all that said, thank you guys for watching. Remember, I'm just a guy on YouTube and this is not financial advice. Investing in any newly public company is inherently risky and you should do as much research as you can before investing.